Breakthrough Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the Close of Business, the COB. I'm Sue Lannon. Now let's have a look at what happened on the market. It was very much a down day on the market. The CBO 200 down 0.8%. The ASX 200 fell nearly 1%. 10 out of 11 sectors fell. Among those going lower, mining, utilities and oil stocks. Healthcare stocks was about the only sector that gained today. So let's have a look at the themes. Everyone was waiting for the RBA rate decision, and RBA holds. So no more rate cuts for Australia for the time being because of hot inflation. And a rate cut may not be on the cards anytime soon. The Reserve Bank forecasting that inflation will stay above 3% at least until the middle of 2026. And in fact, it's predicting headline inflation could reach 3.7% next year, and that's because of the expiry of government power rebates. And Tuesday tumble, the ASX lost ground as it waited for the RBA decision. Did have a brief reprieve after the rates decision came out, but then it fell further as the prospect of rate cuts slipped away. And oil dips. Energy stocks fall as oil drops after 4 days of gains. That's as the market weighed OPEC's decision to pause production hikes early next year. Let's have a look at the sectors of the day. As I mentioned, among those sectors falling were banks. The ANZ lost ground, as did National Australia Bank and Commonwealth Bank, although the Westpac actually ended up 1%. Macquarie Group fell by 0.6%. Let's have a look now at miners. They were among the sector pulling the market down. BHP lost 1.5%. Rio Tinto fell 2.5%. Fortescue fell 3%, and Mineral Resources lost 2.2%. Now let's take a look at energy stocks. As I mentioned, oil prices fell, so that weighed on the energy sector. Santos lost 1.2%. Woodside Energy also fell. Karoon Energy fell 2.8%. Ampol and Beach Energy also lost ground. Let's have a look at some of the stories making news today. An independent expert has backed the planned merger between Southern Cross Media and Seven West Media. Now that's even though a lot of investors are unhappy with the plan, and Southern Cross shareholders won't get a say in the vote. Southern Cross shares rose on the news. G8 Education provided a downbeat trading update, saying an expected increase in occupancy did not occur over this half of the calendar year. And the City Chic Collective saw a strong performance in its Australian and New Zealand business for the 18 weeks to early November. And AI translation firm Straker won a contract with the European Union Translation Centre. Let's have a look now at the stock of the day. That was G8 Education. Let's hear from our experts, Sean Hickman from Market Matters and Rudy Philippek van Dijk from FN Arena.
You can make an argument that even if they have to cut their dividend, that you still get a high yield. So on that's the only basis I would personally think that you could possibly add that to your portfolio. But in general terms, I can't get excited. Even not on a higher share price, and even not at some stage when the metrics pick up. It's just not a sector I can get excited about.
If you've been in it, you wrote it down to these levels.
You have to punish yourself. Eat a whole bowl of mustard, I would say.
I see no reason to be in there at all. But on a micro level, you look at it and you think, well, they should be making a lot of money. It's so expensive to send kids there. The wages are awful. That's a great combination. But then I also don't like the fact that governments are involved. They can determine how much you make. That to me is a huge red flag or two. So I couldn't buy it.
Well, the recent negative news flow hasn't helped, has it?
No. Well, no, it can't. And, it's very bad negative news flow. But at the end of the day, I just think it's a difficult model to roll out exponentially across the country.
As you heard, the Reserve Bank kept rates on hold today, and rate cuts could be a long way away. So welcome to the COB is Adam Swab, CEO and co-founder of Luxury Escapes and also the host of the Contrarians podcast. So Adam, what's your reaction to rates staying on hold?
It's certainly not surprising given the news we had last week that inflation is genuinely out of control at 1% increase in the last quarter and 3.1% annualised, which is frankly catastrophic for the RBA. They talk about this 2 to 3% mythical target range, and for some reason started dropping rates when it was really at the top of that range, and certainly not the bottom. And you'd think you should be cutting rates below the range, not above at the top of the range. So that they went too hard too early. At the same time, you've got federal and state governments massively adding stimulus through huge deficits. So you've got this sort of perfect storm of monetary and fiscal expansion. So there's no surprise that we've got runaway inflation.
Yeah, and they don't sound that optimistic about the future. Michelle Bullock saying core inflation is seen as rising above 3%, at least until the second half of 2026, and headline inflation could reach as high as 3.7%.
And that is not good. So we came off COVID where we saw effectively prices rise between 2019 and 2023 by about 20%, and that's probably being generous. It's probably higher than 20%. So our inflation is off that higher base, remember. So we're really inflating. If you base the 2019 levels, we're kind of inflating at 5% annually now, which is far too high. And the problem with inflation is it really destroys living standards, especially for the middle class and obviously the working class. If you're wealthy, then it's not so bad if you've got assets that appreciate. But if you don't have expensive assets, you're in all sorts of trouble. And this is when governments start getting effectively thrown out. And we saw that with Joe Biden essentially last year, and the Trump sort of landslide as such was really on the basis of living standards being eroded by inflation. So this will absolutely worry the federal government, and it certainly will worry the RBA.
Well, we've certainly seen home prices go up, and Cotality said one of the reasons was the cuts in interest rates.
Yeah, we do a predictions episode on our podcast each Christmas, and we both were saying that the only reason that the RBA will drop rates is when house prices stop going up, and they stopped going up in the first quarter of 2025. So the RBA panicked and dumped rates 75 bips, and unsurprisingly, house prices have popped 10% since. So this is an RBA and a federal government whose sole motive, it appears, is to keep housing prices in this bubble-like state infinitely. They're just so paranoid that if house prices drop, the economy will get destroyed. Then you've got this tiny increase in unemployment from historical lows of 4.1 to historical lows of 4.5. And then that's the second justification for these ridiculous interest rate cuts we saw of 75 bips. So what should have happened is the RBA probably should have been potentially increasing rates 9 months ago, or worst case, keeping them steady and keeping their firepower. They've now gone way too hard too early and probably have to increase rates early in the next year.
So you think it should be a rate cut even though unemployment is rising?
Oh, a rate increase. So
a rate increase.
And we talk about unemployment rising as many economists do, no doubt on your show, but we're rising from a historical low to what is one of the lowest levels of unemployment we've had in 50 years. So I think the problem with every economist in the last 2 to 5 years really is just short memories. And we saw it during COVID when you had Phil Lowe saying interest rates won't rise, which of course was ridiculous, yet people believed it. And then now you've got Michelle Bullock reducing interest rates in the last 6 to 12 months, and people believing this is a new normal, that we can keep these rates at a low level, when it's simply unsustainable when you've got inflation at the time at sort of the high 2s, and now it's sort of at 4% annualised based on last quarter, which is way above what the RBA wants. The RBA really should be targeting an inflation rate of 1.5% to 2%. Any higher and they've got some problems, and they've got some real problems now.
Now, what does this mean for people wanting to get into the housing market?
Well, it really is a myth that low interest rates are better for house buyers. Essentially, prices adjust. So if you look at the reason for house pricing, the reason for any bubble, but especially house pricing bubbles, is debt. Debt is what causes, and the Austrian School of Economics has been clear on this for 100 years, and they've been proven right for 100 years. And look at every bubble that's ever happened, and it happens through speculation, through leverage, and through debt. And that's what we've seen in the last year, case in point. We've seen essentially home buyers bid up the price of homes because banks are willing to lend them more. And then you've got the federal government 5% deposit scheme, which is adding just more fuel on this already ravaging fire. So we've got this perfect storm of house prices rising, and that just makes it harder for younger people to get in the housing market. The last thing a first home buyer wants is higher prices, and that's exactly what we're getting.
Okay, thank you so much for your time.
Thanks, sir.
Now let's have a quick look at the market leaders. Drone Shield rose 9%, Next DC rose nearly 5%, Domino's was higher, Light and Wonder and IPH also gained ground. Looking at the laggards today, Eagers Automotive fell 5.5%, Brambles lost 5%, GQG Partners also lost ground, Hyperion X fell 5% and Judo Bank was also among the laggards. Let's have a look at the small caps now. McMining surged nearly 20%, Narida rose 11% and BetMakers Tech rose 6%. Looking at the laggards, Nova Minerals lost 22%, Rand Mining fell 16%, Trig Minerals fell 13% and Novonix also lost ground. That's after a offtake agreement was terminated. Let's have a look now at what's happening overnight. The ECB President Christine Lagarde will speak. US earnings include Pfizer, Spotify, Uber, AMG, and CSL will hold a capital markets day in Chicago. And looking at the day ahead tomorrow, the main event that investors will be focusing on will be Woodside's investor briefing. And let's have a quick look at the market close. The CBO 200 lost 0.8%. The ASX 200 fell nearly 1% and all sectors ended in the red. Thanks for watching. Have a good night.